Alex didn't panic in 2020. He didn't panic in 2022 either, when rates went vertical and everyone's portfolio looked like a ski slope going the wrong direction. He's not the loudest guy in the room. He doesn't post his wins. He doesn't have a course to sell you. But in the last 4 years, while the average retail investor was chasing meme stocks, panic selling bonds, and dumping money into AI hype cycles, Alex quietly tripled his net worth. Not because he was lucky, because he understood something most people don't want to hear. The market doesn't reward excitement. It rewards patience, positioning, and the willingness to be boring when everyone else is being brave. This is where serious men are putting their money in 2026. Not where influencers say, not where the headlines scream, where the quiet money is actually going. Stay with me. Here's the uncomfortable truth about 2026. We're living through one of the most confusing financial environments in modern history, and most people are navigating it with a map that was drawn in 2015. Think about what's happened in the last 5 years alone. Interest rates went from near zero to the highest levels in 2 decades, then started coming back down, but slowly, unevenly, like a drunk man trying to walk a straight line. The United States added more national debt between 2020 and 2024 than it did in its first 200 years of existence, combined. Let that sit for a second. Meanwhile, inflation didn't fully die, it just changed shape. Groceries, insurance, rent, these things are still eating into purchasing power in ways that don't show up cleanly in the official numbers. And global trade? The world that existed in 2019, where goods flowed freely, where China manufactured everything and America consumed everything, that world is gone. Supply chains are being redrawn, alliances are shifting, countries are stockpiling things they used to just buy. So the question isn't whether the world is changing, it obviously is. The question is, what does smart money do when the old rules stop working? Alex asked himself that question in late 2023, and the answer he found wasn't what he expected. What I'm about to show you in the next few minutes is not a hot take, it's a pattern, and once you see it, you'll start noticing it everywhere. For decades, the advice was simple. 60% stocks, 40% bonds. Rebalance once a year, go home. It worked. For a long time, it genuinely worked, because bonds and stocks moved in opposite directions. When one fell, the other caught it. The whole thing was elegant in its simplicity. Then 2022 happened. Both stocks and bonds collapsed at the same time. The 60-40 portfolio, the bedrock of conventional financial wisdom, lost roughly 16% in a single year, the worst performance in decades. The mechanism that made it work had quietly broken. Here's why. Bonds fall when interest rates rise. Stocks also fall when rates rise, because borrowing becomes more expensive, profit margins shrink, and future earnings are worth less today. So in a high-inflation, high-rate environment, both halves of your safe portfolio are pulling in the wrong direction. Alex knew this going in. Most people didn't. So if the old anchor is broken, what are serious investors using instead? The answer is real assets, selective exposure, and a different relationship with risk. Let's break those down one at a time. Real assets are physical things, or things tied to physical things. Commodities, land, infrastructure, energy, certain kinds of real estate. Here's what makes them interesting in 2026 specifically. We are in the middle of a global reindustrialization. Countries that spent 30 years outsourcing manufacturing are now bringing it back. The United States passed the Inflation Reduction Act and the CHIPS Act. Together, those bills committed hundreds of billions of dollars to domestic manufacturing, semiconductors, and clean energy infrastructure. Europe is doing the same thing. So is India. So is Southeast Asia. All of that building requires materials: copper, lithium, steel, concrete, water infrastructure. These are not exciting words, but they are extraordinarily consequential ones. Copper, for example, every electric vehicle requires roughly 2 to 4 times more copper than a standard combustion engine. Every solar panel installation, every grid upgrade, every data center running AI, all of it needs copper. Now here's the uncomfortable part of the math. Copper mines take 10 to 15 years from discovery to full production. We are not building new mines fast enough to meet projected demand. Existing mines are aging. Ore grades, the quality of what you pull out of the ground, are declining. Demand is rising, supply is constrained, and the timeline to fix that is measured in decades, not quarters. Alex started building a position in copper-exposed assets in early 2024, not because it was exciting, because the math was undeniable. This is what serious investors do. They find asymmetries, places where what is going to happen is already visible, but the price hasn't caught up yet. We're about halfway through, and we haven't even gotten to the part that most financial commentators are completely ignoring. Stick around, because the next section is where it gets genuinely strange. Let's talk about gold, and I promise not to make you feel like you're watching a prepper video from 2011. Gold had a remarkable run in 2024. It crossed $2,000 an ounce, then $2,500. At certain points in early 2025, it touched levels no one had modeled. The standard explanation is that gold rises when fear rises, when the dollar weakens, when inflation runs hot. All of that is true, but it misses the more interesting thing that's happening. Central banks, the institutions that are supposed to be the adults in the room, have been buying gold at the fastest pace since 1967. Not retail investors, not Reddit forums, central banks. China, India, Poland, Turkey, the Gulf states, all of them have been quietly moving reserves out of U.S. Treasury bonds and into gold. Why does that matter? Because for 50 years, the global financial system ran on a simple assumption. If you had excess dollars, you bought U.S. Treasury bonds. Treasuries were the universal safe asset, the parking lot of the world's wealth. That assumption is cracking. Not breaking, not collapsing, but cracking. And serious investors, the ones managing sovereign wealth funds and multi-generational family offices, are repositioning accordingly. Alex isn't betting that the dollar dies. He's not buying a bunker in Montana. He's simply acknowledging that a system which is gradually losing its dominant position is worth hedging against, even a little, even slowly. That's not fear, that's math. Now, let's be honest about something. There is a category of investment in 2026 that is being talked about constantly, in boardrooms, in newsletters, in every LinkedIn post written by someone who just attended a conference: AI. And it's genuinely important. The technology is real, the disruption is real, the productivity gains in certain sectors are already measurable. But here's the thing about genuinely important technologies. They don't always produce good investments in the short run. The internet was genuinely important in 1999. It changed everything. It also destroyed enormous amounts of investor capital before it created wealth. The people who made money from the internet in the long run were often not the people who piled in during the hype. The same pattern is visible in AI right now. NVIDIA had a historic run, but NVIDIA is already priced for extraordinary dominance across an extraordinarily long time horizon. When a company is priced for perfection, the only surprise available is disappointment. Meanwhile, the boring part of the AI story, the infrastructure, the power grid upgrades required to run these data centers, the cooling systems, the fiber networks, that part is less glamorous, but arguably better positioned for the next 5 years. Alex owns almost no pure-play AI stocks. He owns the real estate that data centers sit on.
He owns exposure to the utilities that power them. He owns the companies building the pipes, not the companies promising to rule the internet. This is a very old distinction, and serious investors keep making it in every cycle, while everyone else gets distracted by the headline. Here's something that almost nobody is saying out loud. American exceptionalism in markets may be peaking. For 15 years, roughly 2009 to 2024, the U.S. stock market outperformed virtually every other market on Earth. If you were a global investor and you just put everything in the S&P 500, you would have beaten almost any sophisticated strategy from Tokyo to Frankfurt. That era may not be over, but there are serious reasons to think it is maturing. Valuations in the U.S. market, measured by price relative to earnings,
Historically elevated. Not catastrophically, but elevated. Whereas markets in Europe, Japan, India, and parts of Southeast Asia are trading at significant discounts by the same measure. India specifically is worth watching. It has the demographic profile that China had in the 1990s, a massive, young, increasingly educated workforce that is urbanizing rapidly. The middle class is growing, infrastructure investment is accelerating, and unlike China, India has a functioning democracy and relatively less geopolitical friction with Western capital. This doesn't mean you abandon U.S. exposure. Alex hasn't. But diversifying geographically, in a real way, not just buying a multinational that happens to sell things abroad, is increasingly where serious capital is looking. The question serious investors are asking in 2026 is not just, what do I own, but where do I own it? One last section. And I want to be clear, this isn't the optimistic wrap-up where everything resolves neatly, because it doesn't, and anyone who tells you otherwise is selling something. Let's zoom out. The single largest risk to serious investors in 2026 is not a stock market crash. It's not a recession. It's not even a geopolitical conflict, though those are real. The biggest risk is fiscal instability in the developed world. The United States currently spends more on interest payments on its national debt than it does on its entire defense budget. That is not a political statement, it's an arithmetic one. At some point, no one knows exactly when, that trajectory becomes genuinely difficult to manage without either inflating the debt away, raising taxes substantially, or both. Every serious investor alive has to hold that in the background, not as a panic trigger, but as a gravitational force that shapes decisions. The investors who are doing well in this environment are not the ones who predicted a specific disaster. They're the ones who built portfolios designed to survive a wide range of outcomes and profit from the ones that seem most likely. Real assets that hold value through inflation, geographic diversification that reduces dependence on a single system, infrastructure exposure that benefits from whatever political coalition is in power, a measured, unromantic relationship with gold, and patience, enormous, boring, deeply unfashionable patience. Alex isn't rich because he found the hot trade. He's building wealth because he stopped looking for hot trades. Here's the question I want to leave you with. We live in a moment where information has never been more available and attention has never been more captured by things that don't matter. Every day there is a new asset class, a new narrative, a new reason to rearrange your portfolio based on something that happened last Tuesday. And yet, the investors who consistently build and protect wealth over decades are, almost without exception, the ones who move slowly, think in years, not weeks, and maintain a deep suspicion of their own enthusiasm. The question is not, what should I buy in 2026? The real question is, who are you as an investor? Are you the person reacting to the news cycle? Or are you the person who looked at the copper supply chain, the central bank balance sheets, the demographic data from South Asia, and made a quiet,
unglamorous decision 3 years before it became obvious. Because by the time it becomes obvious, the serious men have already moved. If this gave you something to actually think about, not just feel good about, share it with someone who you think is serious about where the world is going financially. And drop a comment below with this: what is the one asset class you think most people are sleeping on right now? I read every single one. The answers are usually more interesting than the videos. See you in the next one.